Welcome to this explainer. Let's just dive right in and demystify exactly how you can build a massive, totally passive income stream. Now, the median paycheck in America is right around $5,000 a month. Naturally, you might think you need a massive, millionaire-level bank account to completely replace that income without working. But today, we're breaking down a specific blueprint to see if that real number is actually a whole lot smaller than you'd expect.
First up, we really have to look at why the most common financial advice out there might actually fail you for this specific goal. So, what's the magic number if you follow standard advice? Just buy the S&P 500 and try to live off the dividends to hit that $5,000 a month? Boom, $5.7 million. Yep, you heard that right.
That 5.7 million figure, it completely exposes the core flaw in standard retirement advice. The common just buy the S&P 500 strategy is asking you to hoard almost 30 times what the average American actually retires with, which, by the way, is roughly $192,000. It's a fantastic tool, don't get me wrong, but the S&P was built for pure growth, not for paying your monthly bills right now.
So the big question is, how on earth do we bridge that intimidating gap without falling into the traps that trip so many people up? Is it actually possible to hit $5,000 a month starting with just a $10,000 initial investment and tossing in roughly $7 a day? Basically, the price of a fancy coffee. Let's unpack the math.
Part 1. Myth-busting the alternatives. Why high yield is a trap.
Okay, before we get to the optimal funds, we have to clear out some bad advice. We've all been tempted by real estate, single stock picking, or even crypto, right? They sound incredibly smart on paper, but man, they come with severe stress. Real estate? Say hello to 2 a.m. phone calls about a busted water heater. Single stocks? Literally one bad earnings report can wipe out an entire year of gains. And crypto is just a wild financial roller coaster without a seatbelt. Index funds let us gracefully skip all that headache by spreading your bets across hundreds of companies for a much smoother ride.
Now, here is the absolute biggest rookie mistake we see with new dividend investors. The second they hear dividend investing, they start chasing artificially high yields, like 7%, 9%, even 12%. But listen, a massive yield is almost always the market screaming that something is terribly wrong. It signals falling share prices and imminent dividend cuts. You might think you're getting paid more, but you're effectively buying a sinking ship that just happens to be handing you a check on its way down.
So instead of boarding that sinking ship, we absolutely need to focus on total return. Think about it. A smaller starting yield of, say, 2.5% that actually grows its payout by 10% every single year will easily crush a static 7% high-yield fund in less than a decade. The high-yield fund just sits there treading water while the growing one compounds like wildfire.
To build a true income engine, every single fund we pick has to pass through 3 crucial pillars. Step 1, paying us a reliable yield right now today. Step 2, consistent dividend growth that will literally double our income over time. And Step 3, share price appreciation. That means our actual principal balance keeps growing in the background, even when we aren't selling anything.
Part 2, the 5-fund portfolio, assigning every dollar a specific job.
All right, let's look at the actual roadmap. We need a specific mix where every single fund has a very distinct job. VDAX is our growth engine, holding giants like Microsoft that constantly hike their dividends. Then we've got VENX for energy, a sector a lot of folks are ignoring right now, but it's paying out a solid 2.48%. VTIX casts this massive net over international stocks, grabbing over 8,000 companies. VIHAX zeroes in on the highest-yielding international companies, totally ditching the non-payers. And lastly, VIAX is all about pure international dividend appreciation. It is the perfect blend of reliable cash today and aggressive growth tomorrow.
Now, if that table felt a bit overwhelming, take a deep breath. Managing this is actually incredibly straightforward. You literally just chop the pie into 5 equal slices. Exactly 20% goes into each of these uniquely different funds.
And when you run the numbers on that exact equal split, something pretty amazing happens. By equally weighting those funds, your blended portfolio dividend is growing at a whopping 11.05% every single year. At that rate of growth, your passive income is essentially doubling roughly every 7 years. Talk about a snowball effect.
Part 3. Running the numbers. Visualizing the 30-year timeline.
Okay, let's trace this out. Say we start with $10,000 and throw in just $7 a day inside a tax-free account. After year 1, you're looking at about $13,497. A bit of a slow start, sure. By year 10, you hit around $66,000. But wait until year 20, you cross $239,000. That right there is the magic inflection point, where your reinvested dividends start heavily blowing past your daily contributions. And by year 30, it has completely snowballed into an $895,338 account, handing you exactly $5,000 every single month. And the best part? You never had to sell a single share.
If you're sitting there wondering how buying a coffee's worth of index funds every day turns into nearly 900 grand, check out this breakdown. Over those 30 years, your actual out-of-pocket cash is only about $86,650. The market's appreciation tacks on over $431,000, and those sweet compounding reinvested dividends pile on another $377,000. So the market is literally doing the vast majority of the heavy lifting for you.
Part 4. The Fast Track. Visualizing the 20-year timeline. But what if you don't have 30 years to wait? What if you want to completely replace that paycheck in just 20 years? Let's say we start with $70,000 up front and bump the daily contribution to $35. Because you gave the portfolio a huge head start, compounding just hits the ground running. You land well over $1.3 million in just 2 decades. And at that level, the portfolio is kicking off $5,128 a month in pure dividends. You're hitting that exact same monthly income target 10 whole years faster.
Part 5. The time versus money trade-off. The humbling truth. When we place these two strategies side by side, we run into a deeply humbling financial truth. The 30-year coffee plan takes about $86,000 out of your pocket over its lifetime. The 20-year fast track? That demands over $325,000 out of pocket. This is the brutal reality of compounding, guys. Shrinking your timeline by just 10 years forces you to come up with almost 4 times as much of your own hard-earned cash. Time really is the absolute greatest multiplier you have.
Which brings us to the ultimate trade-off: patience versus upfront capital. You either let time do the heavy lifting for you, or you pay a hefty premium in cash to speed up the clock. So as you look at this strategy and start mapping out your own financial future, I want to leave you with one vital question to think about. Time or money? Which price are you willing to pay?